Okay. Now, this is hilarious. This is a clip I got from TikTok or Instagram, how you have agents out there talking about IUL, Index Universal Life. Look at these illustrations. Oh, they're so great and beautiful. It's like a beauty pageant, right? Which one is the prettiest from any other company? Do you think common sense that a company is going to take your $100 for your child's policy every single month for the next 30 plus years or 50 years, and you're telling me that they're going to just give you $1 million tax free for lifetime income for your child when they reach retirement for only collecting like 150 plus $1,000? Maybe ask yourself, is that reality? Do you think that that's going to happen? Why? Because your pretty illustration said so? I guarantee these agents out there or this gentleman doesn't even have an IUL, nor has he ever looked at his current annual statement or the original illustration he had sent in for his policy if he does have one. Do you think that you would give your money away if you ran a company for $1 million and only collecting 150? And the reason why these illustrations look so pretty for anyone that actually has an IUL is because there is positive arbitrage. You are getting a compounding effect of money at 6 or 6.9 or whatever they illustrate these stupid numbers on percentages. These aren't average rates of return. These are actual rates of return that you're seeing. That means that you are getting a 6.95% compounding on that index every single year to the day you die. And that is not going to happen. See, these are not average rates of return, which is what they tell you. These are actual compounding numbers. Now, if you look right next to the highlighted column, you'll see something that says alternative non-guaranteed. Right now, that is illustrating at 4.75%, which means that if you were compounding at 4.75 every single year on the month and the day of that index that you have it, which you can't illustrate that, you can see that if someone is taking tax-free income from this policy, even with this tax-free income, you can see zeros on all those columns after the surrender value. And see what that means is that the cost of insurance is still coming out of this account, whether you take money, stop making premiums, borrow money. That policy, my friends, if you took $1 million and now there's $0 in that policy to pay for the premium, because Universal Life are all annual renewable term policies. It's a permanent life insurance policy for 100 plus years, but it's based on a term chassis. So every year as the cost of insurance goes up based upon your age, you still have to pay it. Whether you stop making premiums because your agent or your illustration said at 62 or 65, you don't have to pay premiums. The cost of insurance is getting liquidated and surrendered out of that policy's cash value. If you get a zero in some of those years, guess what? And you're taking out $50,000 or $60,000 a year because your illustration said so on your agent, and now you have to pay the cost of insurance as well. That might cost you $30,000 a year and the $50,000 you took out for your tax-free income. So $80,000 is coming right out of that cash account. Yeah, good luck making that up next year in that nice index you have. But that right there, my friend, if that comes out to a 4.75% guaranteed compounding interest every single year, and they're taking out income, you're going to pay taxes on $1 million. And that policy is exploded and we call implosion. Yeah, just wait for a lot of lawsuits coming out in the next 7 to 15 years. And you'll see a lot of agents running for the hills because all they care about is commission, not the client. You heard it from here.